You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, I have a lot going on today in the markets. With the Fed decided to inform us what we knew already, that they were going to raise interest rates by the Fed funds rate by 1/4 point. First time they've done that since 2018. And I should also let you know that we are taping Options Playbook Radio. It is March 16th. The markets are closed right now. So we had a volatile day in the markets, to say the least, in that markets were up big going into the Fed meeting. As soon as the rate hike was announced, which everybody was anticipating, the markets dropped, and then they came back, and then they dropped again. So all within about a 3-hour span, we had a lot of volatility in the S&P 500 index, NASDAQ, and everything above the fold. So last week, I was not available to tape the podcast, so we did a best of event last week. And then prior to that, we did a fear of missing out trade in the SPYs, kind of looking for some way to make a play to get long the marketplace without all the risk. So we talked about buying a deeper in the money option contract, going out a little bit further in time, and we chose the SPY SPY, which tracks the S&P 500 index. Not much to say on that front. That trade is still alive and well. The markets are still just showing the volatility, even though the VIX index, the VIX index has been waiting for this Fed meeting, and because of that, after the Fed was announced, we did have the VIX index fall off because it was waiting for the news. Markets stabilized a little bit, and today it closed at 2667, and it was down on the day about $3.16. On a percentage basis, it was about 10.5%. So I think I'm going to kind of run with that. I haven't talked about the VIX index and trading VIX options in quite some time. So my theme, even to go all the way back to the SPY straddle that we discussed before Russia invaded Ukraine, we talked about, is it time for a long straddle? Saying that the VIX was a little bit low at that point in time, and I have no idea what's going to happen, and why don't we just buy some premium and say, well, if they don't, the markets are good. If they don't invade, then the markets will probably go up, And if they do invade, the markets are probably going to go down. And that was definitely true. And we do have a ton of volatility. So today we're going to look at VIX options. It's going to be a very simple trade. It's going to be highly speculative because when you talk about the VIX index is just a confusing beast to try to tackle when you are trading option contracts. Part of the reason why is that the actual VIX, the spot, if you're going to talk about futures, what you do have to talk about when you're looking at the VIX, is the actual VIX. That's where the VIX index is as of today. It's based off of a moving 30-day average of volatility in the S&P 500 index. Now, you go out further in time. You go out to June, July, August. That VIX spot doesn't really drive the prices of the option contracts. Now, just like any futures market, eventually the spot is going to play a very important role as expiration approaches. But right now, the actual driver of the option chain is where the futures are at for the expiration date of that option contract. So we had a sell-off in the VIX. We have a rise up in the marketplace. Now, still a lot of unknowns geopolitically as far as the world is concerned. I do not think the VIX should be around a 26.67 range, and not meant to be a recommendation, especially if we're talking about the VIX, because it is a very volatile, confusing underlying to trade. But as always on Options Playbook Radio, we're just trying to look at underlyings that might match some of the strategies. So we get kind of creative here to come up with ideas to address all the different strategies inside the playbook. And then to go along with it, based off of that underlying, you're going to take a different approach. We talked a little bit about Google and Amazon around earnings and how we adjust our trade just because of the expense of the underlying. Over $2,000 on the stock that affects the option prices. So you're have a bigger tendency to do a spread than you would do just an outright buy of a call or a put if you were bearish. And that definitely applies on the VIX. So with that mantra on VIX options, let's look at a long call spread. We're going to manage our risk. And actually, to the call side, long call spreads are very interesting to do because of the volatility skew. So we're going to look at the March 30th expiration. And right now, that March 30th futures contract for the VIX is just a little bit higher, just a smidgen higher than where the actual spot index is at. We're trading right around 27 on the futures contract, which is another reason why I might decide to do this trade. We're basically where the spot is at. Very rarely do you see that happen. Recently, what has been the case is that the futures have traded at a much higher premium relative to where the actual VIX symbol or spot index is at. So this is going to be a short and sweet Options Playbook Radio, but we're going to go out 14 days in time on a very volatile index, which means next week when we come back, we'll have something to talk about. It should be a very interesting trade. Another thing that happened in the VIX is the volatility of the actual VIX option contracts, which is tracked by the VVIX. The VVIX is the VIX of the VIX, if you will. And over the last 5 days, the volatility of the options in the VIX index has actually dropped precipitously, all the way down from 130 5 days ago to right now. It's currently trading, and I'm going to round off a little bit, at 114.48. So we've had a decrease in the volatility on the options. We've had a decrease in the actual VIX index. We got the futures contract trading right around where the actual spot is at. So we're going to go out 14 days in time. We're basically, if we're doing this trade, we're speculating on a big news event. And if the big news event brings the market down, well, then this trade should work out okay. And we're not going to risk a lot. Why? Because this is a risky trade. So we're going to do a 1-by-1 long call spread where we're going to be buying the March 30 27 strike call, selling the March 30 29 strike call. We're going to do this for a net debit at the midpoint. Now, remember, the markets are closed right now, of 57 cents. That means for every 1-by-1 spread that we do, we are going to receive we're going to pay $57 plus commission to do that trade. Now, I kind of like the risk reward of the trade. We are buying something that's relatively at the money, selling something that's out of the money. It's really hard for the VIX index, in my opinion, to get up above the 30 level. So I don't want to sell the 30 because I do want it to finish above our short strike. So we're going to sell the 29. We're hoping that the VIX might spike up to 35, 36 in the short term. If not, we just want it to be above 29 by that expiration date, which at this point in time is 14 days away. Now, if the market does go down, and usually the VIX does inverse of what the market is doing, you do usually see the VVIX spike a little bit, and that's not good for a long call spread. And part of the reason why is that you are selling an option contract that you really want time premium to come out of. That option contract that you're selling is fighting the one that you bought. Now, the one that you bought has more power. We paid more for it. It has a higher delta. And because of that, though, you want to be correct on your forecast closer to the expiration date, or you want implied volatilities to come in, which, if we are correct on our forecast, most likely the VVIX would actually spike up. Okay, so picking that expiration when you're trading VIX options is extremely important. Even more so, we've talked about this a lot on Options Playbook Radio, about just doing long call spreads and what expirations you like to choose. Here, I'm just more looking for a news event. And I think over the next 14 days, there could be a big news event. Now, that news event might make the markets go up, might make the markets go down. We don't know what it is, but I do expect some type of news. And that's why I'm talking about VIX options, because I think people are considering VIX options, and I think you need to address them. And the biggest thing about it is you don't just dive into the VIX. You have to do some research on it before you trade it. It's not like trading options in Apple, Google, Facebook, SPYs, Walmart, even the S&P 500 index by itself. It is a totally different beast. So we will look at this. We will paper trade this trade for this week, and we'll come back next week, and who knows what will happen, and we'll have something to talk about. The one thing that I can pretty much come close to guaranteeing, there's always a chance, but the one thing that I can lean on is that the VIX will most likely not be at 2667 1 week from now when we tape Options Playbook Radio podcast once again. So that should give us some fodder for the next podcast. So let's recap. Very short and sweet this week, mainly because we didn't have a trade to recap from last week. But we're looking at the VIX options. We're going to do the March 30th expiration. We are going to be buying the 27 strike call, and at the same time we're going to be selling the 29 strike call. Right now the midpoint with the market closed is at 57 cents. That means for every 1-by-1 spread that we do, we have risk of $57 plus commission. On the upside, you take the difference between the strikes, which is 2 points, minus the net debit that we would pay here if we could get it at 57, and that gives you $1.43 of upside. So if you can find a reason to get bullish in the VIX index, A lot of times long call spreads just look interesting because of the way that you see the skewing in the volatility. So to I guess emphasize that point, we're going to be selling in that VIX index approximately 140% vol, and we're going to be buying approximately 133% vol. And I say approximately because the math overall on VIX options and option change isn't always the best because they got to base it off the future. But right now, the future for that March 30th expiration is fairly close to the spot, the actual VIX index. Part of the reason why it's interesting to do this trade. All right. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. If you'd like to learn more about the educational events that we do at Ally Invest, please follow me on Twitter. I tweet about all of those events. My handle is very simple. It's at my name, at Brian Overby. And thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.